Everyone was holding their breath for the March CPI, and it just came in hotter than expected on the headline, but the number the Fed actually cares about came in cooler. Here's exactly what this split means for your rent, your mortgage, your groceries, and your 401k in the next 60 seconds.
Let's get right into it.
Welcome to the deep dive, everybody.
Yeah.
We're tearing into the March 2026 Consumer Price Index report, which literally just dropped on April 10th.
Fresh off the press.
Exactly. And we're not just skimming the raw government press release today. We've got a massive stack of fresh data and analysis sitting right here.
Oh yeah, we're looking at reports from the Conference Board, EY, Techie, RSM, US.
Plus some really fascinating market insights from ONDA and M&I. So we're covered from all angles.
We really are. And honestly, it is a massive data dump. Like, the narrative underneath the surface here is completely fractured. We're basically looking at the ultimate tale of two economies.
Right, which brings us to our mission today. We are decoding all of this. We want to translate this financial earthquake into simple, everyday terms.
Because you need to know exactly how this impacts your wallet, right?
Yeah, today, tomorrow, and through the rest of the year. No jargon left unexplained. So to understand what just happened to the economy, we first need to look at this massive, glaring split in the numbers you just mentioned.
Yeah, to do that, we have to look at the exact figures driving the split. So, the headline, CPI.
Which is the big one.
Right, that's the big overarching number you see on the news. It measures the total basket of goods and services we all buy, and it came in undeniably hot. It rose 0.9% month over month.
Wow.
Yeah, that is the largest single monthly increment we have seen since June 2022.
That's huge.
It is. And year over year, headline hit 3.3%, which, by the way, is the highest annual reading since May 2024, so nearly 2 years ago.
I mean, on the surface, 3.3% sounds terrifying. It really feels like we're going backward. That is definitely not the direction the Federal Reserve wants to see when their stated goal is, what, 2%?
Exactly, 2%. It sounds super alarming, well, until you lift the hood and look at the core CPI. Right.
Core is the metric that strips out food and energy costs entirely.
Because those are so volatile, right?
Exactly.
Yeah.
Notoriously volatile. And core came in at just 0.2% month over month.
Oh, wow.
Yeah, and 2.6% year over year, which is actually a hair cooler than the 2.7% that Wall Street and all the economists were expecting.
Okay, let's unpack this, because I know a lot of people hear that and get incredibly frustrated. So headline is like the noisy alarm going off, but core tells us whether the house is actually on fire.
That's a great way to look at it, yeah.
But like, why does the Fed ignore the stuff we actually buy every single day, like gas and groceries? It feels like a rigged game to the average person. You know,
Oh, for sure.
you can't just tell me inflation is fine because you decided not to count the fuel I put in my car and the milk I put in my fridge.
Yeah, no, I hear that all the time. But what's fascinating here is that the Fed doesn't exclude those costs because they don't care about your grocery bill.
They separate them because food and energy prices are primarily driven by global commodity shocks or weather patterns or geopolitics.
Things they can't control.
Exactly. The Fed operates one single blunt instrument, and that's domestic interest rates. So if they raise rates, they make borrowing more expensive for American consumers and businesses.
Which slows down demand.
Right, but raising interest rates in Washington, D.C. does not magically put more oil barrels on ships in the Middle East, you know?
Right.
So they use the core CPI because it reveals the actual underlying trend of the domestic U.S. economy. It tells them if the fundamental gears of our economy are overheating.
And right now they aren't.
No, the core data is showing us that underlying price pressures are relatively contained. The core engine just isn't matching that headline surge.
Okay, so if the core economy is chilling out, what exactly is setting off this massive headline alarm? Like, what's making all that noise if it isn't domestic spending?
It's almost entirely an exogenous geopolitical energy shock. I mean, the data we're looking at from the Bureau of Labor Statistics is just stunning.
Yeah.
Gasoline prices skyrocketed 21.2% in a single...
I mean, a 21% jump in 30 days.
Yeah.
That is brutal.
It's insane. It's actually the largest monthly gain since the series began tracking back in 1967.
Oh my God.
Yeah, and fuel oil spiked 44.2% year over year. So according to the breakdown, that single line item for gasoline accounted for roughly 3/4 of the entire headline CPI increase.
Okay, I want to dig into the mechanism of that explosion at the pump, because the analysis here points directly to the war premium, right?
Exactly.
This is a direct consequence of the ongoing conflict with Iran disrupting Gulf shipping and crude flows.
Yeah, the oil supply chain is incredibly brittle right now.
And we are seeing some diplomatic movement, like there are talks scheduled in Islamabad this weekend.
Right, with the U.S. delegation meeting Iranian officials.
Yeah, so there is a sliver of hope for de-escalation, especially after that recent 2-week ceasefire. But the market clearly doesn't buy it yet.
Not at all.
They're pricing in a massive amount of supply risk.
And that risk is what you are paying for every single time you fill up your tank.
It's like a leaky pipe that's currently only flooding the basement.
Oh, that's a good analogy.
Yeah, like it's a toxic, expensive mess down there in the energy sector, but the rest of the house, the core economy is dry for now.
Right. But, a leaky basement doesn't stay in the basement.
True.
It causes mold that slowly creeps up into the floorboards, and eventually it rots the framing of the house. So the Fed is sitting in the living room trying to figure out if they need to bring in a massive industrial dehumidifier.
Which would be a major interest rate hike.
Exactly. Or if they can just wait for the leak to dry up on its own.
And that brings us to the most important question for you, the listener. The mold is creeping up. So how is this energy shock, combined with a cooling core, actually hitting your bank accounts today? Let's talk real wallet impact.
We should probably start by looking at where the core economy is actually providing some relief.
Yes, and here's where it gets really interesting, because there is actually some genuinely good news in this report for normal people. Hidden right behind that scary headline number.
Yeah, so shelter and rent costs are finally showing signs of cracking.
Finally.
I know, right? Shelter makes up about 1/3 of the entire core CPI basket, and it has been the most stubbornly sticky part of inflation for years.
Because landlords just had immense pricing power.
Exactly. But this month, shelter rose just 0.3%.
Wow.
Yeah, and on an annual basis, that ties its lowest level since August 2021.
That is massive.
It is. The pipeline of new apartment buildings finally coming onto the market is forcing landlords to compete for tenants again. So if you're a renter, this is a huge signal that the painful double-digit rent spikes we saw over the last few years are leveling off.
That is a massive deal, because rent basically dictates the entire foundation of a household budget. And looking at the EY and M&I data here, used cars are actually down 0.4% for the second consecutive month.
Yeah.
So big-ticket core goods are seeing real disinflation. But I was looking at the EY data on groceries, and frankly, I was confused.
Oh, the grocery data is wild.
Yeah. It says food at home was technically down 0.2% for the month, driven by cheaper cereal, dairy, and meat.
And eggs.
Right. Eggs have apparently collapsed 44.7% year over year from their peaks. But my grocery bill feels higher than ever. Is there a lag here, or am I just buying the wrong thing?
No, you're not crazy. You are feeling the compounding effect of the last 3 years of inflation, even if the month-over-month pace has stalled out.
Oh, I see.
Like, the prices haven't gone back to 2021 levels, they just stopped climbing as fast. But, and this is the scary part, EY is warning that this flat grocery data might not last.
The mold from the basement.
Exactly. This is where we see the mold creeping up. Higher transportation costs and higher fertilizer costs, both of which are heavily dependent on those exploding crude oil prices, are likely to push crop and livestock prices back up.
Oh.
Yeah. EY expects food inflation to rise back over 4% in the near term, as those massive logistics costs bleed directly into the supermarket aisles.
And the travel sector is already feeling that exact bleed, right?
Oh, big time.
Their fares spiked 2.7% month over month, and they're now up 15% year over year. Car rentals jumped 1.3%. If you're planning a summer vacation, jet fuel costs are being passed directly onto your boarding pass.
And this brings us to the pain point that hurts the absolute most.
Ouch.
The erosion of purchasing power, yeah. RSMUS highlighted a brutal statistic regarding real wages. Real wages are your actual paycheck adjusted for inflation.
Right.
So in February, real wages were increasing at a healthy 1.4% pace. People were finally getting ahead of prices.
Feeling good.
Right. But in March, entirely because of that 21% spike in gasoline, real wage growth slowed to a crawl of just 0.3%.
Okay, let me put that in perspective. Your boss gave you a raise. Your paycheck is technically bigger, but the sheer cost of your commute to work is eating almost the entire raise.
Exactly.
Wait, so my rent might finally stabilize, but my summer vacation and my commute are going to bankrupt me. How does the average person budget for a two-speed economy, where big things are getting cheaper, but everyday necessities are exploding? Like, generic advice like, save more, doesn't work when gas hits $5 a gallon.
No, it doesn't. You have to actively reallocate.
What do you mean?
The actionable takeaway from this data isn't just to tighten your belt, it's to use the leverage the core data is giving you to offset the pain in the headline data.
Okay.
Like if your apartment lease is up, you actually have negotiating power for the first time since 2021. Negotiate that rent down or lock in a flat renewal and take that saved money and immediately reallocate it to your commute and your grocery budget.
That's smart.
Yeah, and avoid the travel spikes by staying local. You really have to aggressively harvest the savings from the cooling core to pay for the burning energy sector.
That makes total sense.
Right.
But if my wallet is getting squeezed this hard at the pump, my immediate thought is that the Fed needs to step in and fix this.
Right.
But we just established that the Fed relies on the core number, and core is cool. Does that mean the Federal Reserve is just going to sit on their hands while gas gets more expensive?
Well, this split is exactly what dictates their policy.
Yep.
The cool core number just gave the Federal Reserve the analytical cover it needs to essentially do nothing.
Wow.
Yeah, because shelter cooled and because the inflation spike was clearly an imported supply chain issue tied to the geopolitical situation in Iran, they are not going to hike rates to fight this.
So if we connect this to the bigger picture, what does doing nothing actually mean for your borrowing costs?
The baseline expectation across all these economic notes from EY to RSMUS is that the Fed will hold rates exactly where they are through the summer. They need time to see if the oil shock fades. The projection was previously for multiple rate cuts this year. Now, the consensus is maybe one tiny 25 basis point cut, 0.25% in December 2026. Or, and this is entirely plausible, 0 cuts this year.
0 cuts. Let's make sure the mechanism here is crystal clear. If the Fed makes 0 cuts, it means mortgage rates, credit card APRs, and car loan rates are staying painfully high for the foreseeable future.
Absolutely.
There's no cavalry coming to slash your interest payments in half this summer.
No, you are going to be paying a premium to borrow money for the rest of the year. Following the data release, the yield on the U.S. 10-year Treasury note actually edged up to 4.31%.
Wait, let's break that down real quick. Why does a government bond yield going up mean my personal mortgage gets more expensive?
Because the 10-year Treasury yield acts as the foundational benchmark for global finance. It's essentially the baseline risk-free rate. Banks use that exact yield to price 30-year fixed mortgages.
Oh, I see.
Yeah, so when the yield goes up, banks immediately raise mortgage rates to maintain their profit spread. So an uptick to 4.31% means the dream of a sub 6% mortgage is being pushed even further over the horizon.
That brings me to the strangest part of this entire data dump, which is the stock market.
Oh, yeah.
Because typically, when headline inflation hits a 2-year high and bond yields spike, the stock market throws an absolute tantrum, panic selling, red screens everywhere.
Right.
But it didn't crash. Why did the market just shrug at a 3.3% inflation print?
So think of Wall Street like a casino where you bet on tomorrow's weather, not today's.
Okay.
By the time this CPI report actually came out, traders had already spent 3 weeks watching the news out of Iran and watching the price of crude oil climb. They operate on forward-looking curves.
So they saw it coming.
Exactly. They had already priced the oil shock into the market. This CPI report was just a receipt for a meal they had already eaten. What Wall Street truly cared about was the core data.
Because the core data proves the domestic house isn't on fire.
Bingo. Because the core data came in at a cool 2.6%, Wall Street loved it. It removed the tail risk from the equation.
What's tail risk?
Tail risk is the remote doomsday scenario for investors. In this case, the nightmare scenario, where the Fed panics over the energy spike and actually starts raising interest rates again. Once the core data showed that rate hikes were off the table, the market could relax.
And the techie analysis pointed this out brilliantly. They noted the AI and infrastructure trades held incredibly strong through this whole print.
They really did.
The S&P 500 ETF, SPY, closed at $679.91.
Okay.
The NASDAQ 100 ETF, QQQ, closed at $610.19. And NVIDIA closed at $183.91, which is right near its year-to-date high.
That's wild.
We are looking at a bizarre reality where a massive tech company can trade at record highs, padding everyone's 401k, while the average consumer's real wage growth collapses. How is the tech sector so immune to all of this?
It basically comes down to cash reserves and pricing power. Massive tech and infrastructure companies have balance sheets loaded with cash, so they don't need to borrow money at these high interest rates to fund their operations like a small local business does. Their corporate profits are dramatically outpacing the drag of higher interest rates.
So your retirement accounts and your investments are safe for now. The stock market is playing a completely different game than the grocery store.
Yeah, but this raises an important question.
That's that.
If the Fed holds rates higher for longer, just to wait out this Iran conflict, how long until those high borrowing costs fundamentally break the broader job market?
Right.
We are already seeing alarming cracks. Trading Economics noted that consumer sentiment plunged to a record low in April. The public is exhausted.
They really are.
Businesses are passing on tariffs, fuel costs are soaring, and consumer credit card debt is getting more expensive by the month.
It's an endurance test for the average household.
It really is. Look at the Institute for Supply Management data. Their employment index fell to 45.2, pushing it deep into contraction territory. Companies are pulling back on hiring. The labor market might be the next thing to crack if the Fed holds rates up here too long.
So what does this all mean? Let's bring this massive deep dive all together. The March CPI report is ultimately a story of patience for the Federal Reserve and pain at the pump for the consumer.
Exactly.
Your investments are largely fine. Wall Street is happy because the underlying economy isn't overheating. Your rent might finally slowly start to give you some leverage. But borrowing money is going to remain painfully expensive, and filling your gas tank is going to hurt for the foreseeable future.
Yeah,
You have to play defense with your budget and reallocate those rent savings into your daily commute.
definitely. And, I want to leave everyone with a brilliant concept from RSMUS analysis to mull over as we look ahead. They called this energy shock a symphony in two movements.
Ooh, I like that.
We just experienced the first movement today, right? The immediate, visceral spike in gasoline prices. But oil is the lifeblood of the entire global supply chain. Oil literally makes everything.
Right, the mold creeping up from the basement.
Yeah,
The second movement.
exactly. What happens next month or the month after when the cost of plastics, the cost of packaging, and the cost of the petroleum-based fertilizers used to grow our food finally hit the supply chain?
Wow.
Will the cost of the plastic clamshell box your spinach comes in drive up your grocery bill before the cost of the actual spinach does? That is the critical mechanism we have to watch in the April data. Does the energy fever stay isolated at the gas pump, or does it infect the rest of the core economy?
That is a terrifying but absolutely necessary metric to watch out for. We'll be tracking that second movement closely to see if the core economy can hold the line. If this helped you understand what's coming for your money, smash that like button right now. Drop the word CPI in the comments below so we know you're watching. And make sure you're subscribed with notifications on because we're going for every major economic report this year. See you in the next one.